Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Once again, this is your tutor, Accounting Made Simple tutor, Samuel Muchai. And I want us to do a question. I want us to solve a question as CPA 1. CPA 1 Financial Accounting, May 2018, question 1. May 2018, question 1. Now, the question reads, Asuba Enterprises is a business run by a sole trader. The following trial balance was extracted from the accounts of the business as of 31st of March 2018. Is that 1st of March 2018? We told capital 1852, 800,000. Inventory, that's opening inventory, 242,000. Sales, 4.2 million. Purchases, 1.6. Electricity, 22,300. Discounts received for the 2,700. Purchases, returns, 6,400. Like I've always said in the past, ensure that as you read through the question, always read through the question. And as you read through the question, you are already formatting your answer in your head. You're already formatting your answer in your head. You're already realizing the items to include where every one of those items falls. So discount allowed, so we know it's an expense, 24,200. Motor vehicle expenses, 15,800. Drawings, 320,000. Bank balance, 245,110. Salaries, 1080. Insurance, trade receivables, irrecoverable debts. Irrecoverable debts, you must know that is the other name for bad debts. Allowance for receivables, that's allowance for doubtful debts. Allowance for doubtful debts. Trade payables, general expenses, 9% loan. Every time you find that there is a loan somewhere, remember to compute the interest expense, even when you're not told. Even when you're not told under additional information. Interest on loan paid, as if you are told how much has been paid of the interest. Land and building, accumulated depreciation, equipment at cost, accumulated depreciation on equipment, motor vehicles, accumulated depreciation on motor vehicle. Number one, you are told only 10 months salary are shown in the trial balance. An equal amount is paid for salaries for each of the months. So definitely, then you're supposed to compute the monthly salary, but you know that 10 months have been paid, meaning 2 months have not been paid. Number two, as of that 1st March 2018, the 2,000 shillings had been prepaid and therefore prepaid for insurance. So insurance, you subtract that 2,000, the balance you take it to income statement as an expense, and that too becomes a prepaid prepayment, which is a current asset. Whereas 4,100 was owing to general expenses. And therefore you get the general expenses, you add 4,100 and then you record general expenses payable amounting to 4,100. For the 6,000 have been charged to general expenses for the owner's private holiday. That is drawings. As of that 1st March 2018, inventory was valued at 225. You get the closing stock and the inventory in the balance sheet. A customer owing 5,400 was declared bankrupt. This amount is to be written off. So you debit bad debts account, and you must realize that you already have bad debt expenses in the trial balance. So you're just adding more. You add 5,400. We are told it has not been written off. The one that is in the trial balance, it has been written off, but now this was need to be written off more. More need to be written off. So you add the 5,400 to what is already written off. Then we are told an allowance for receivable. Once you get your debtors, you subtract bad debts, which we are now subtracting 5,400. The remaining amount you compute 3% to get allowance for doubtful debts, so that you can know whether that allowance is the same as the allowance in the trial balance. If there is a difference, an increase we always say is an expense, and a decrease, we always say, is an income. You know how to handle that. As of that 1st of March 2018, land was valued at 1 million. Land is not depreciated. So you get the land and building, you subtract 1 million, which is for land, the remaining is depreciated, and you are given the rate for the depreciating building is 4%, equipment 25%, motor vehicle 40%. I want to repeat again. When computing depreciation, you must know the difference between depreciation on cost. You look at the original purchase cost, but depreciation on reduced balance, you get the net book value at the beginning of the year. You get the balance shown in the trial balance minus the accumulated depreciation at the beginning to get the net book value at the beginning of the year. There are no additions or disposals of non-current assets during the year. So quickly, we do our workings, and the first working you deal with is loan interest. It is loan interest. It is loan interest. The first working is loan interest expense. The first working is loan interest expense. And we are told our loan is 9%. 9% of 1,500,000. 9% of 1,500,000. 9% of 1,500,000. 0.05. 0.09 of 1,500,000. We get 135,000. We get 135,000, and we are told that later at the trial balance, we are told interest paid is 120. So this is the interest expense, the total interest expense for the year. The total interest expense to charge is 135,000, but we are told less interest paid. Less what? Less interest paid. So we thought interest paid is 120,000. Giving the balance is an interest payable of 15,000. We get interest payable of 15,000. Interest payable of 15,000. And therefore, 135 is our interest expense in the income statement, but we have a current liability of 15,000 called interest payable. Number one, of additional information you are told, only 10 months salaries are shown in the trial balance. In other words, you're being told it is only 10 months salaries which have been paid. It is only 10 months salaries which have been paid. So, if we get our salaries, it is 1080. Salaries paid. Salaries per month. Salaries per month is equal to salaries paid divided by 10, which is equal to 1080,000 divided by 10, which is 108,000. That is the monthly salary. So total salaries, both paid and non-paid for the year, is 108,000 times 12. This gives you the salaries expense. That gives you the salaries expense. 1, 2, 3 times 12. We get salaries expense of 1296. We get salaries expense of 1296. We get salaries expense of 1296,000. But we are told we have this is for 10. We have only paid for 10 months, which is 1080, and therefore for 2 months we have not paid. And we know monthly salary is 108. Unpaid salaries. So we say salaries payable. Salaries payable. Salaries payable. It is 108 times 2. 108 times 2 times 2. Because we're told 1080 is what was paid for 10 months. Now the remaining 2 months, because the monthly salary is 108 times 2. 108,000 1, 2, 3 times 2, we get a figure of 216. So this is salaries payable. This is salaries payable to be shown in the balance sheet as a current liability. That is salaries payable to be shown in the balance sheet as a current liabilities. Number 2, we are told, as the 31st March 2018, 31st March 2018, as that first March, that's the end of the year. That first March 2018, shillings that 2,000 had been prepaid on insurance. So if we get our insurance balance from the trial balance, insurance expense account, the balance brought down for insurance Insurance is 154,000. 154,000. We are told that that 2,000 is prepaid, so it's not an expense. So we cut it down. We cut it down. It's not an expense, so we don't take it to P&L. We cut it down. Don't take it to the income statement. We don't take it to the income statement. So 154 minus 32. We only take 122 to the income statement as an expense. We only take 122,000 to the income statement as an expense. We only take 122,000 to the income statement as an expense. We are told, well, 4,100 was owing to general expenses. So general expenses, what we have not paid everything for general expenses. We have not paid all our general expenses. We are told we are owing. Balance brought down from the trial balance. Balance brought down from the trial balance general expenses is 67,800. 67,800. 67,800. And we are told we have not paid. So remember, we recognize expenses when incurred, not necessarily when paid. When incurred, not necessarily when paid. We recognize expenses when they are incurred, not necessarily when they were paid. And therefore, we add 4,100. We add 4,100, but we are saying there is something called general expenses payable. General expenses what? General expenses what?
Yeah.
Payable. So we are adding 4,100 from general expenses. We are adding 4,000. So general expenses payable. General expenses payable. Then we are told, number 3, 46,000 had been charged to general expenses for the owner's private. Within these general expenses, we have some 46,000, which is owner's private expenses, private holiday. So that is drawings. So we remove it from general expenses and take it to drawings. We remove it from general expenses, we take it to drawings. And from the trial balance, you can see we have a drawings account of 320,000. We have a drawings account of 320,000. So if we create drawings account, and then we say balance brought down is 320,000. Balance brought down is 320,000. And here we are told we remove 46,000 from general expenses, we take it to drawings. 46,000. We take 46,000 to drawings. So we add 46,000, and we are saying it is coming from general expenses. Then we are told the closing inventory was 225. Closing inventory is 225,000. We know where to take it. It's a current asset and a reduction of purchases. Cost of goods sold. A customer owing 54 had been declared bankrupt. This amount is to be written off in full. Then debtors, bad debt expenses account. We get a balance brought down of bad debt. Look, every time you are reconstructing an account, you must check whether it has balances from the trial balance. You must check whether it has balances in the trial balance. You must check whether it has balances from the trial balance. And we have irrecoverable debts amounting to 14,200. 14,200 from trial balance. And then we are saying trade receivables. Our trade receivables account. The balance brought down from trial balance. Balance brought down of trade receivables is 11,01,400. 11,01,400. And we are told we write it down with an extra additional information number 5, 5,400. 5,400. So we add 5,400, and we come here, we say bad debt. We reduce our receivables. With the 5,400. We reduce our receivables with the 5,400. Yes. Then we are told this amount is to be written off. Now, an allowance of receivables is to be maintained at 3% of the remaining receivables. So our balance carried down, once we get our balance carried down, we now provide for doubtful debts. You must realize that we provide for doubtful debts after we have deducted all bad debts. We provide for doubtful debts after we have deducted all bad debts. So 1101,400 minus 5,400, we get a figure of 1051 thousands. And we are told now on this, after deducting bad debts, we calculate allowance provision for doubtful debts. Provision for doubtful debts, basing ourselves on the trade debtors after deducting bad debts. Trade debtors after deducting bad debts. Trade debtors after deducting bad debts. And therefore we apply, we thought to check, the rate will be maintained at 3% of the remaining trade receivables. So 3% of the remaining trade receivables, 0.03 of 123, we get a figure of 31,530. Once you get the closing provision for doubtful debts, always go back to the trial balance. Always go back to the trial balance. If you don't find any provision for doubtful debts in the trial balance, that figure becomes an expense in the income statement and a deduction from trade receivables in the balance sheet. Or a deduction from trade receivables in the balance sheet. But if we have an opening provision for doubtful debts, you compare with the closing that we have already calculated to find out if there was an increase or a decrease. We say if there is an increase, we say is an expense. An increase in provision for doubtful debt is an operating expense. A decrease is an income which is classified as other incomes. Is an income which is classified as other incomes. An income classified as other what? Other incomes, as other income. So if you go to a trial balance, our trial balance figure tells us our allowance for doubtful debt is 31,530. So it is still the same figure, 31,530. And therefore, we are not increasing, we are not reducing. So once we get the trial balance to the balance sheet, we will get our debtors 1051,000. We subtract 51,530 to get net trade debtors. To get net trade what? Trade debtors. Now we are told, as of that 1st March 2018, land was valued at 1 million. Land is not depreciated. And then you are given the depreciation rate for building, equipment, and motor vehicles. So building, so if we say depreciation expenses, building, equipment, and motor vehicle. We are told building is 4%, equipment is 35%, and motor vehicle is 40%. Now, for the building, if you look at the trial balance, we have been given a figure for land and building, that for 3,400,000. And therefore, because out of the 3,400,000 of buildings, we are told land is 1 million, and we are told that we are not depreciating land. So you subtract that 1 million from 3.4 million, you are left with 2.4 million. So you multiply 4% with 2,400,000, 0.04 times 2,400,000, 123, we get 96,000. We get 96 what? We get 96,000. We get 96,000 for building. 96,000. Now, for equipment, we are told it is 25% per annum on cost. So the original purchase cost of the equipment original purchase cost is 220,000. 0.25 of 220, 1, 2, 3, we get a figure of 55,000. So we get a figure of 55,000. And please mark that we are told motor vehicle is on the reducing balance basis. So you get the original cost minus accumulated depreciation at the beginning of the year to get the net book value. So we get original cost for the motor vehicle is 260,000 minus the depreciation at the beginning of the year showing the trial balance 132,500. 132,500. Giving us a figure of 260,000, 260, 1, 2, 3, minus 132,500, we get a figure of 127,500, then we apply the depreciation rate times 0.4. We get a figure of 51,000. That becomes the depreciation expense for motor vehicles. Depreciation expense for motor vehicles. We are told there are no additions or disposals of non-current assets during the financial year. Then you're supposed to prepare the income statement, the statement of financial position, and then explain some few things here and there. So let's do the income statement. We have Asumba Enterprises. Income statement for the year ended that year, 31st March 2018. So our sales is for the 214,500. Our sales is 42,14,500. Always remember to have your format in the head. You can never go to a financial accounting exam before you have memorized the format for the income statement and balance sheet, for sole proprietorship, for the company accounts, and for partnership. Even the format for statement of cash flows. You must remember sales less returning hours, get net sales, less cost of goods sold, opening stock, add purchases, add carrying hours, less returns, get cost of goods available for sale, less closing stock. You get the cost of goods sold from sales, you get the gross profit, then add other incomes, get aggregate profit, then you less operating expenses to get the profit for the. You must remember the format so that you eliminate what is not there in the question, but whatever is there, you capture it. So there is no sales returns. So you say less cost of goods sold, less cost of goods sold. And we have an opening stock, 242,000, opening stock. There at the top, the second item, 242,000. We add purchases. And always, as you do that, find out whether any of the items in the income statement is being affected by your adjustment. Don't just go to the trial balance. Move, don't be in a hurry and cause trouble. Always check whether any of the items which is in the trial balance has been adjusted by our workings. So our purchases don't appear to have been adjusted. 1673,500, 1673,500, 1673,500. So we add 242,000, 242, 1, 2, 3, plus 1673,500. We get a figure of 1915,500. 1915,500. We have returns outwards. Less return outwards. Less return outwards. Or purchases returns. And we said that the purchases returns are 6,400 from the trial balance. 6,400 minus 6,400. 400, we get a figure of 1855 100. 1855 100. We less, this is cost of goods available for sale. So after trade receivable, we come to prepayments, and we know that we have insurance prepaid insurance of that 2,000. So we come here and say prepaid insurance, 32,000, prepaid insurance of 32,000. Then we go to the bank. There is no other one there, so we go to the bank. From the trial balance, we get bank balance of 245 110. 245 110 bank. From the TB, 245 110. 245 110. Remember the format. You check whether you have any cash balance. You don't seem to have a cash balance, so we add the 4 items. 225,000, 225, 1, 2, 3, plus 1019 470, 1019 470, plus 32,000, plus 245 110, 245 110. We get a figure of 1521 580. 1521 580. 1521 580. 1521 580. Total current assets. Total current assets. We add to the non-current assets to get total assets. We add non-current assets of 31,82,500 plus 31,82,500. We get a figure of 47,04,080. 47,04,080. 47,04,080. 47,04,080. And then where did we get the funds from? We say financed by capital and liabilities. Capital and liabilities. And quickly we go to the trial balance and we get our capital. From the trial balance is 1852,800. 1852,800. Then we go to we add profit. We add profit for the year. Profit for the year. And you know, we said our profit is 719,300. 719,300. We add 1852. 1852. 800 plus 719,300, 719,300, get a figure of 2572,100, 2572,100. We say less drawings. We say less what?
Drawings.
Less drawings. And our drawings are here, but this is 6, this is 6, 3, 66,000. So we say less drawings 366,000, the 366,000 minus 366,000. 1, 2, 3. Get a figure of 2206,100. 2206,100. That becomes our closing capital. That becomes our closing capital. Let me ask ourselves, do we have non-current liabilities? Yes, we have a 9% loan of 1,500. So we say non-current liabilities. Remember the format? Remember the what? The format, we have 9% loan and it is 1,500,000. Then we go to current liabilities. Always starting with bank overdraft. We don't have bank overdraft. Then we have accounts payable. We ask ourselves, do we have accounts payables? Do we have accounts payables? Do we have accounts payables? And it is there. It is trade payables amounting to 762,880. 762,880. Trade payables. Trade payable. 762,880. We ask ourselves, do we have any other payables which are shown here in our workings? We have general expenses payable here. General expenses payable of 4110. General expenses payable of 4110. Any other payable? Drawings, trade receivable, profit depreciation. Then we look at the trial balance and we check whether there are any other payables. But we actually had this one, interest payable. Interest payable 15,000. We have interest payable of 15,000, and we also have salaries payable of 216. Interest payable 15,000. Interest payable 15,000, and salaries payables of 216,000. Salaries payable of 216,000. Salaries payable of 216,000. We check whether there are any other current liabilities in the trial balance which are payable, and I don't get any. I don't get any. So if we are to add the four, we get 762,880. 762,880 plus 216. 123 plus 15,000. 123 plus 4110. We get a figure of 997. Let me do it again. 762,880. 762,880 plus 4110 plus 15,000. 123 plus 216,000. 216. 123. 123. Get a figure of 997. Something is amiss. 762,880. 762,880 plus 4110 plus 15,123 plus 216. 123. Yeah. Now. Our general expenses, like you can see here, our general expenses payable is 4,100. Is 4,100. It is not 4,110 like we have captured there. So we collect here to 4,100. 4,100. So if you add all that now, you get 762,880. 762,880 plus 4,100 plus 15,000. 123 plus 216,000. 123. We get a figure of 997,980. 997,980. 997,980 plus the non-current liabilities. That's total current liabilities plus total non-current liabilities plus closing capital plus 1,500,000. 123 plus closing capital of 2206. 2206. 100. We get 470,40,80. We get 470,40,80. 40, 80. You get 470, 40, 80, total capital and liabilities. Total capital and liabilities. And it balances with the total assets. It balances with the total assets. That's the way the question was supposed to be done. That's the way the question was supposed to be done. Once again, I want to ask you to support us, subscribe, like, share, comment, and hit the notification bell so that when we load this kind of videos, we will be able to let you know. And kindly invite and inform your friends and also join our online classes. Thank you very much.